This is a first for me today, interviewing 4 people at the same time. 5 of us on this podcast episode. First, Jerry Parker. Second, Moritz Seibert. Third, Richard Liddle. Fourth, Gareth Abbot. After my most recent episode with Jerry and Moritz, we decided, let's expand it out. And we added Richard and Gareth from Bowmoor Capital. So sit back and enjoy a wide-ranging conversation with a whole team of trend-following traders. I tell you the thing that I would like to know for Richard, Gareth, Moritz, what is it about this guy, Jerry, that makes you interested after all these years? What is it about him that keeps you intrigued? What is it about him that he says or explains that keeps you engaged?
Who told you that they felt that way?
Maybe they don't. I'm just assuming. But let's go with the assumption that perhaps I'm right. Let me let you start, Richard.
Jerry, fantastic to meet you. Good to see you again, Moritz. And I think I'll start because I'm probably the newest member, shall we say, to the trend following world out of the others. So I was introduced to trend following very much through Gareth. And Gareth obviously speaks very highly of the history of trend following, the TurtleTraders, of which obviously we look back at the history and there your name appears. So for me, it's reading that history. It's looking at where it's come from, why this strategy works in the environments that we're in. And really, for me, as an ex-military man, history is important, and you appear all over that history. So for me, fantastic to be here, fantastic to meet you, and you are part of the trend following, the historical component that is trend following. And for me, that's why I've read into everything that is about the TurtleTraders era. And it's fantastic to see a lot of what was put into those rules replicate into what we are doing at Bowmoor today. And, it's fascinating to see that. But that's why I follow it. That's why I have utmost respect and regard for everything that is done. I suppose as the newest member to the trend following community, quite an easy one for me to do. And I'm honoured to sit leading Bowmoor, really following in those footsteps.
Gareth, what do you think?
I might ramble on for a bit about this at the point where I start.
I'll stop you if you grapple too hard.
Yeah.
I'm deadly at the axe,
Yeah, as soon as I come over as all stalker, just get in there. I'm a huge fan. Jerry, you are, I would say, all trend following eyes a legend in this area. I can't thank you enough. The Turtles have been one of my biggest influences. Probably the big 3 would be the Turtles, Ed Sikota and Perry Kaufman. They've been my biggest influences and still are today. My system's pretty much based on everything I could learn from you guys and then just filling in the blanks, doing the rest of the mathematics to complete the system. So yeah, it's a huge deal to speak to you. Been a career-long fan, and it really is a big deal for me to be on the podcast with you and get the chance to talk to you today.
Moritz, I didn't realize the other guys had not met Jerry yet, but Moritz, you do know Jerry a little bit more, so let me let you maybe pull back the covers a little bit more on your perspective that why Jerry has inspired you or influenced you over time.
More praise for Jerry. He and I go back a long time, a lot of respect. But what I've noticed in Jerry is that when I think I first met him 20 or so years ago, is it fair to say that you've been a bit shyer? You wouldn't be as talkative. I mean, you'd be speaking with me about position limits on the exchanges, but you would never go on a podcast. That has changed in, I'd say, the recent 10 years or so, where you've become more outspoken about trend following, going on podcasts, now publishing articles on Substack for the first time, things like this. This is not the Jerry that I got to know more than 20 years ago. I don't think he would have done it back then.
Don't forget Twitter.
Yeah, well, so I'm getting off of Twitter. You're still on it. Yeah, stuff like that. But obviously, as far as trend following is concerned, there's nothing under the sun that Jerry hasn't seen. I found it very funny, just to say this, last time we spoke, and he said, when the Bank of England raised rates in the morning and lowered them in the afternoon. So these are the type of market events where it's like, I didn't even know that ever happened, but that have been fun to live and trade through it.
Jerry, before I let you comment on the young guys, let me let you follow up on what Moritz said. So why exactly did you decide to become a social media trend following darling rock star kind of guy? Because I agree, I'd met you for the first time in 1995 and definitely would not have felt like this would be your thing, but you clearly love it.
That's right. I love the Twitter because it's perfect for an introvert to sit back and start typing and limit the criticism and get your points across and stuff. And so that's really fun to do. I love Twitter. I can't get into LinkedIn as much, but Twitter is just this really fun thing to every day put something out there and be a little critical or confirming. For introverts, I had this conversation once with somebody, and she said, "Did you speak at the conference today?" And I said, "Yes." She goes, "I can never get on stage and speak." But it's easy to get on stage and speak because people are there to hear you, and then you can just say whatever you want to say with minimal negative feedback. You want to avoid that, of course. But I said to her, it's this cocktail party that drives me crazy. I'm not good with the small talk and the one-on-one talking. And am I holding up my end of the bargain? Are people enjoying me? I get very self-conscious about that. But yeah, the podcasts are fun because I'm able to do my thing and not say what I want to say. And I have a lot of strong opinions. Although I have a bad reputation because 90% of the time, if you listen closely, my main comment is, it's not as extreme as it's being made out to be. It's pros and cons, and I'm going to come down somewhere in the middle, but I'm always arguing an extreme point of view, but I'm seldom resting in that view. It's usually the world's full of choices. You have to make them. And I'm usually going to take up the side of the choice that's not getting a lot of attention. Classic trend following, for instance. But yeah, Moritz and I have had some good times together and good interactions together. And we had dinner one night. My wife still talks about it, primarily because of the distance Moritz had to drive to come have dinner with us. It was this ridiculous hours-long drive. And so we've never forgotten that and always enjoyed him and his company. And we're like-minded on so many different issues.
That was the dinner in Zurich. It wasn't too far. That was 3 hours. Not a big deal.
Both ways.
Yes.
I got to share really quickly. When I first attempted to stalk Jerry in 1995, I remember driving through the fields, the cornfields of Mannequin-Sabbett, Virginia, thinking, where the blank am I? What is he doing out here? There's no infrastructure out here. And it's one of those light bulb moments where you say, the location with this particular strategy is not exactly what it's all cracked up to be. Let me take you guys to something really to get into the meat of the matter that people might want to hear about, which is current time right now, let's say 2025. And trend following has had some rough stretches here. Some drawdowns. Guys at Bowmoor, let me let you jump in and offer some perspective.
From a trend following perspective across the board, it's been a tricky year. We can't argue with that. With global events, certainly some of the tweets that come out of the US, which have affected the markets, and I think a lot of us were on the wrong side of a number of those earlier in the year. I think other than being a tricky environment, there's not a lot to say. I think beating the SocGen index, which certainly we are doing at the moment, is a positive place to be. Some trends are starting to show their hand as we go into the second half of the year, certainly Q3 and Q4. But Gareth, where would you, some of the events that happened this year and how they affected us, thoughts?
This is just part of the process. Every trend follower knows that. It's business as usual, really. A drawdown this year, performance has been strong coming into this year. You're going to spend most of your time in a drawdown unless you happen to be on a particular day where you've broken your all-time high or the high water mark, then you're in drawdown. So it's probably bigger than average at the moment. I mean, we all know why stocks have been particularly difficult for trend following this year. We've had that kind of movement that's one of the weaknesses of trend following when you have the kind of flash crash, and that's been one of the ways that we've been whipped a bit this year. With trend following, you've got to draw a line in the sand somewhere. There's a line at which you will either exit, potentially reverse, and there's a balance. That's part of what you accept when you're trying to trend follow. Stocks and currencies, pretty much all the financials were difficult this year, the first half of the year. Kind of sudden weakening of the dollar was also difficult in the first half of the year. There have been some good trends, some long-term primary trends, which are still driving us this month as well. Gold, one of those that's on a multi-year trend at the all-time, recently setting all-time highs, has been a good downtrend for us, and another strong multi-year primary trend. And cattle, of course, I'm trying to avoid setting anyone up for a particularly bad joke here about a bull market. But yeah, very strong uptrend in cattle. We're all-time high. But yeah, I think the real difficulty this year has been the flash crash we had in April in stocks, and just dealing with that from a performance point of view and system performance rather than investment performance. The system's doing everything it should do, and it's not designed to profit through noise and chaos. And maybe some people do design systems that are specifically set up to profit in a flash crash, but I'm not aware of any trend followers doing that. I'm happy how we've managed this year.
Moritz, let me get you to follow up on something Richard said about the tweets causing situations like this. Has anyone done any work or done any research? Has there been a situation where a world leader has been able to shake markets this much with a simple piece of information put out onto a social media platform? Is this a first this year?
Yeah, could be. I didn't do any research, and I'm not aware. I'm not old enough to really have experience too much about that.
You're only 19, I know, right?
Yeah, that's right. 18 and a half. Yeah, but yeah, I've never experienced anything like it, and it's a fact now. It is a factor in the markets. Tariffs on, tariffs off. Taco trade. We're extending the deadline. We're bringing the deadline closer. We're delivering weapons. We're not delivering weapons. We're doing this. We're doing that. It's back and forth. Think, from my perspective, we're trading probably, as all of us on this podcast do, relatively long-term systems. So when you have these moves in the market triggered by a tweet, they rarely kick us out of a position. They did kick us out on Liberation Day. It's like this was the mother of all tweets. It's kind of, oh, he really does stuff now. And we just took a massive hit, for instance, on the JGB. That was our biggest losing trade, if I remember that correctly, on that day, followed by currencies. It was not the equities, by the way. As Gareth, I think, was alluding to, the trend following systems have that very nice feature. You go into this period of inconvenience, but you're starting to release risk from the portfolio. You're getting kicked out of positions, and the stuff that you had on, which you're now exiting, maybe with a profit on a give back, maybe with a small loss, is now gone from your portfolio. And you're moving towards a position of a clean slate where you're starting fresh with new trades. There's no guarantee that they will work again. They could be small losing trades, but you've released a lot of risk from the portfolio. That is one of the things that makes that process very stable and very protective, ultimately also to the downside.
Jerry, what do you think about all this tweeting affecting markets and the current drawdowns of the trend following world?
I think that usually what happens when we go through these periods, someone writes a paper, AQR has done it, and others basically saying the reason trend following hasn't done well is because there hasn't been a lot of big trends. So no surprise there. It's the same thing. We haven't had trends in the currencies or interest rates very much. A narrow portfolio like Bowmoor, and you get the gold and the cocoa, and you hit it, that's going to work out a lot better than being vastly diversified, because the commodities, except for just a handful, hasn't had major moves like we saw in 2020 when the whole sector took off. We did have some outliers, but the whole sector took off. We have a lot of diversification, and I know it's going to be a big topic today. One of our funds has 400 markets, another one over 100. Moritz has probably over 100 as well. But classic trend, the way we practice it, it has more diversification in some respects, but not as much targeted diversification like Bowmoor would have, where they're really trying to create the portfolio that's going to, on a daily basis, through not only the makeup of the markets, but the rebalancing, it's going to have a lot more diversification, like us trading 400 markets, but really a lot of the markets are similar, and maybe we're overweighted and not perfectly 25% each sector, or 1/9 of all 9 sectors, depending upon how you divide it up. So I think in some respects, you would think that having a lot of markets and a lot of opportunities and diversification would make it better for us this year, but it really hasn't been the case.
Let me jump you guys around a little bit here. Something that's been near and dear to me recently, and I'm just amazed about this. I told one of my assistants recently, I said, hey, take my podcast and drop it into one of these AIs and give me an example of AI Mike. And she did. And I started sharing this MP3 with friends and family. And I wouldn't tell them what it was. I would say, hey, what do you think? It's only like 15 seconds. And it just was like me saying something, trend following is great, whatever. They would write me back and they go, oh, that sounds awesome. And then I would say, it's not me. So the question I have for you guys with that little bit of a setup, and I'll let you actually start this time, Jerry, is there anything in your world right now, your trend following world, that's being affected, or that you're changing things or doing things differently or using AI as a tool in any way yet?
AI is a point of emphasis on compliance here in the US. So I got to be careful. But I think writing papers, writing tweets, communicating, it's so easy. And I have a perfectionist streak. So I start to write something. I know it's not going to be perfect. I freeze up so I can throw it into ChatGPT and I'll be more happy with it. The other day, I've heard people talk about to write code on Twitter and other places. Like, I'm using AI to write code. I know I asked ChatGPT who the president of the United States was a few months ago, and I had to argue with it until it finally said, yes, you're right, it is Trump. But the other day, I asked ChatGPT to do a research project, a back test. With just in a few minutes, we were able to dialogue with each other, and it came back with a perfectly wonderful back test, just like the ones we do with our Python. I just skipped that one part to ask it to give me the Python code. I just went straight, just give me the results. And so it's just pretty humorous and how easy it is. I own the original System Writer software in 1988, I say. And that's, if you don't know what System Writer is, it's the precursor to TradeStation. So you could write it in easy language, normal English maybe, and do some rudimentary back testing. And so now we fast forward to just tell ChatGPT what you want, what the results, what you want them to do and the results. And I asked, the next time we run a research, are you going to remember all this? And it said, yes, I'm ready. Send me more. So that's pretty amazing stuff for me.
Moritz, what do you think?
I'm using ChatGPT to help me with emails, to do research. It's a better version of Google. You get a more useful answer, I think. Even though, as Jerry was saying, it's not always correct. You have to stay switched on so that you're not trapped and reading incorrect things. But we're not using it for trading. Never say never. Maybe at some point we will. But I do have some reservations of AI for the type of stuff that we do. I can completely understand why AI makes a lot of sense in a high-freq setup where you have massive sample size and also a very defined corridor within which the AI is then meant to operate, because it's like the rules of the order book, and the order books all function slightly differently on every exchange and for every market. But in our way of trading, there's so much noise, vastly more noise than a signal. And I just fear that the AI is going to learn things which it will show me that it produces a nice backtest, but which I think we all on this call know that this is not the right way of trading. One of the reasons we're making money is because we're taking in some pain. We're doing some difficult things that other traders find hard to do. AI might take on trades that are easy to do, that are kind of like the nice way forward, but I'm sure if there's any money there.
Gareth, can you prove that you're not AI right now?
Good point. I'm not sure. As you say, it's very hard, isn't it, to determine. So far as trend following is concerned, I think this is what people are curious about within the strategy. I just don't think optimization is useful for trend following. It's not new in that sense. Guys like Perry Kaufman and others like them who are researching in the area of mathematics and trend following have long written about the mathematics behind this, neural networks, genetic algorithms, which are more effective, in my opinion, than neural networks. But for trend following as a strategy, it's not what you want to be doing. You want to avoid optimization. I always like the way Kaufman describes the loose-fitting pants, and you need to have that strategy which can adapt. The markets are ever evolving, ever changing, and you just can't optimize. Useful as a tool, email, writing documents, potentially looking at results as well, making tables, but not as a strategy, not as a trend following strategy.
We've discussed the trading elements here, and certainly for myself, on a personal level, more quite embedded in AI and actually building agents which are just beyond ChatGPT. So platforms such as N8N, where you can link them all together. So you link your GPT with your Grok 4, and then you link it to certain platforms like X, YouTube, and the likes, and actually utilizing that from a marketing perspective, where I could just say, here is our strategy, here is our fact sheet, produce me X number of whatever that might be. So from a marketing and a distribution standpoint, actually it's a fantastic tool. One of the things I do think it will develop into, and Gareth alluded to there, is we're not using it to develop strategies because we're not looking backwards. That's not what trend following is. What I would quite like to do, as I say, with some of these more advanced agents, so not just a single platform like GPT or like Grok, it's actually where you're linking them all together, is almost put some of our system rules into it. and ask it to optimize them, ask it what it thinks, and ask it what it would do better, and allow it to learn our strategy. And that's the piece of work that I'm working on. The downside of it is I don't want to put it into the likes of ChatGPT or Grok 4 because then they're open source.
I should note right now that Gareth has lowered his background to prove that he is not AI. Yes, yeah. We now know he is an actual live human. Jerry, if we had to look ahead, and look, we all want to imagine on this call that we're all going to live forever, but if we had to look ahead, Jerry, 10, 20, 30, 40, 50 years, where do you see the acceptance of a trend following strategy going? I have a little bit of an internal side bet with myself that a lot of the people, for example, and I know several of them, I'll say some more in a second, but the BTC crowd, the Bitcoin crowd, a lot of them have a trend following ethos, even if they don't have it defined. But Jerry, how do you see trend following in the decades ahead? Will we get to acceptance? Will it become something super popular?
Probably, yeah. I usually have to debate other trend followers on this issue, but I think trend following is greater than buy and hold. But I think a lot of what people say and do, they don't come out and say that's not true, but they act like it and talk about it as if it wasn't true. There's this worshiping of passive indexing. We all just know that's amazing and superior. And we just grovel for 5 or 10% of your portfolio. It's all we're worth. And we're going to alter our systems and choose the markets we trade possibly to better fit into these amazing stock market represented by an index. And so I think that the index is inferior. It's not a good replication of real trend following. And eventually, when stocks don't have the best performance and buy and hold doesn't beat everything every year, trend following will settle into its rightful place of having, because it deserved it with more diversification, better rules. I think the stock market wins because it's hard to beat the stock market because it's a rule-based system. It's not a good rule-based system, not the systems that we have. And so eventually, the better systems with the more diversification, the more markets, the shorts, it will win out. I think that two things are going to occur along the way. They probably need to occur. One is abandoning crisis alpha. It's true to the degree that it's true. I don't have a problem with there is some sort of crisis alpha idea out there, and it does seem to work out that trend following has done well sometimes, most of the time, let's say, when stocks sell off. But the whole idea that it's just the way that CTAs define themselves. Managed Futures defines itself as, here's how we help your overall portfolio. When the fact of the matter is the numbers justify trend following, diversified CTA trend following to be the majority of the portfolio and maybe a little bit of long only bonds and long only stocks. And then without a doubt, CTAs are never going to be taken seriously. And they shouldn't be until they trade single stocks. It's a ridiculous situation where everybody here is guilty except for me. And that is, you can't keep trading these indices. You would never trade the dollar index. You would never trade a commodity index only and give up all this wonderful diversification you have by trading the individual markets. And yet we're satisfied primarily because of where we are in the overall investment industry. It's just an add-on, like you're a futures trader, trade the futures, leave us alone, quit causing waves. But it would make our programs and our performance better to break apart these indices, trade 20 or 30 or 40 or whatever stocks that are going to be much more suitable for long-term trend following and produce some outlier trades and have some longs and shorts on. It's so far superior to trade the individual names, just like it is to trade the individual currencies or the individual commodities. When the big crash came earlier this year in the stocks, all the indices were near all-time highs, but 30 or 40% of our stocks were short. So we came in every day around that period short and long, but just not going to get that level of diversification. And the world revolves around equities. And so when it suits us, let's embrace that and trade those. But until CTAs become known for trading stocks, having a stock-only program, trend following, stocks only, and things like that, they're not going to be taken very seriously.
Moritz, any disagreements with Jerry there?
First off, I don't hope that the strategy is going to be so popular that everybody kind of accepts it. Speak about this very selfishly, but every marginal dollar that goes into the trend following space and competes for the same signals and entry points and exit points as we do is something that will on margin deteriorate our returns and expectancy. Sometimes we hear let's grow the pie together, and CTA money or trend following trading money isn't that much relative to the overall pie that's out there. And when you trade the largest markets, only the largest financials, that's one way to say that. But in our case, where we trade canola and palm oil and California carbon allowances and these type of things, I don't want too many other traders to be messing around with these markets when we're about to do it. So yes, grow it to a point, but I'm also very happy if it then kind of like stops there. Not everybody needs to be a trend following trader. Not sure if the capacity is there for everyone. And by the way, we also don't know how much money is flashing around there following trend strategies with retail traders who don't report to databases, some of the institutional internalized money that doesn't report to databases. It's absolutely unclear. Notional funding, how much money is there trading trend following strategies? Nobody on this call knows. Nobody on planet Earth knows. But the larger it gets in expectancy, the smaller the returns. As far as the stocks are concerned, some people, by the way, trade the dollar index. And I agree with Jerry, like they still do. Some people trade the dollar index. I don't do it. Some people trade, there's a futures contract on the S&P GSCI commodity index, and some people probably trade that one. We are registered as a CPO. We're not registered with the SEC. That prevents us from taking on single stock exposure. It will be different in Europe here. We're under this regulatory framework where we just cannot easily expand the cash equity space. I do agree with Jerry that breaking up these indices into their component parts unlocks a diversification benefit that otherwise remains unavailable to you. There are the complexities that go along with trading cash equities. They function differently. You need to fund them. The short side is different. You need to locate the stock, be able to borrow it. You may not be able to hold on to your short position because it may be called away, all these type of things. So I've never done it. Jerry's the only one on this call who has practical experience with it. I can only comment on it from a theoretical perspective. And from that point of view, I need to agree with him that there is a diversification benefit that you can get. You can already see this, by the way, on the sector level. You can break the S&P 500 into its whatever, how many gig sectors there are, and probably improve that way already.
Gareth, perspective?
Guys, it's on my bucket list. It's something I look at, find it fascinating. There's a few things on that bucket list. At some stage, I might get there and run the analysis on the individual stocks. It's a really good take on it, Jerry. Yeah, that's something I'd like to get stuck into. I mean, at the moment, my system framework is largely inspired by the Turtles, and that's the same layout in the system manual, the markets we're trading, how we position size, the entry signals, the stops, signals for taking profits, execution tactics. I've thought through it in a very similar way, and we're pretty much trading the same market universe as the Turtles, adding grains and meats, which I believe the Turtles had reason to avoid those markets originally. The point being high quality diversification that we want there. The least number of markets to achieve high quality diversification and to avoid return dilution, without relying on any emerging or minor markets. The version of the original Turtle system that I've been running throughout my career ran into some difficulties with the shorter term approach. The way forward for me wasn't necessarily to change the markets. I don't think the markets were broken. I don't think markets break. And I didn't think about trying to fix the performance or look for performance by expanding the market universe and just looking for more trends. I've always believed that is a really good market universe that was originally had across financial and commodity, and that we've got a really good selection within that, the 21, an equal balance of financial and commodity. I think the system diversification is more important. This, I guess, might lead us in to discuss this with Dow theory and turtle breakouts. For me, that's more important, the source of alpha there in the system diversification, where we have the multi-strategy, multi-frequency approach to trend following. And that's the most powerful part of our diversification. The markets offer us that high quality diversification to run the system on. Execution, the best it can be in those major markets. And it allows for ultimately what we're all about is trend capture. That's what all the system development is about. We want a system. We want to maximize the efficiency of the trend capture. That doesn't mean that the perfect entry and exit, getting in or out at those market turning points. It means maximizing the trend to capture with the trend following system and being as efficient as we can. That's what I want to see before I start just looking for more markets and more trends. Absolutely would like to look at the single stocks. I'm really quite focused around the turtle markets.
Richard, looking ahead, back to the first part of that question to Jerry, looking ahead the 10, 20, 30, 40 years, how do you like to imagine trend following, acceptance, potential popularity?
I'm always going to say I'd like to see the popularity increase. It's obviously gone through waves throughout the years of being in favor and not in favor. And I think we're now potentially in a period of time this year with the returns that trend following is showing that it may not be the most favorable of strategies out there, because people are just looking at the returns from equities and they're looking at the potential returns that they're seeing without potentially or losing that focus on the longer term. I think the ability for trend following to show its robustness has been shown over, the decades that have gone by. And I think it's just a case of now potentially market. And this is why I spend a lot of time looking at the word. As we all know, it's not the best strategy that ever wins the race. It's the best known strategy that wins the race with regards to assets under management and what they're running. And that, from my side of this business and the operational side, is key. So for me, it's more about getting it more known, more understood, the position and the place in an investor's portfolio. And I think the work that I'm keen to do over the next few years on that will enable the strategy, trend following to become more well known, and hopefully Bowmoor to become the top of that tree. So yeah, I see longevity. It's just the education of the investor.
Let me share a fun little story. I met an individual the other day. I will not give up too much information, but he assured me, and I had other sources at the table to verify, but he assured me that he was responsible for Bitcoin going from 40 cents to $4. And at one point in time, about 15 years ago, he had 25,000 Bitcoin. I still think he has a significant chunk. I don't think he has to work anymore. But it's interesting to watch. Here we are, Bitcoin out $117,000 a pop. Whenever I have these Bitcoin conversations with people that are into the Bitcoin, you bring up something like trend following. Most every one of them, they don't have a perspective of trend following. They don't know about it, or they haven't heard about it. They usually just have the hodl thing, hold on for dear life. More props to them for the people that have pulled that off. What is the current perspective, all of you right now, on Bitcoin? Because it is an amazing market. Is there any more amazing market in the last 15 years than Bitcoin?
I would certainly love to have a crypto element. And Gareth knows this. We've discussed it. And we recently, or last year, launched a new fund, Global Alpha Aggressive, where it's just a slightly more aggressive portfolio or different 21 markets. And initially in the planning phases for that, two of the currencies were going to be Bitcoin and Ethereum. Ultimately, they ended up, and the reason for that, they were the only ones that were on the CME, allowing them to be traded with ourselves. They ended up obviously trending very similar, so it was like you were just trading double Bitcoin. For a number of reasons, we elected to keep the markets the same and just increase the volatility. However, personally, I think there's a huge opportunity for a true trend following crypto strategy, because you can't deny that they trend. They're not going away. They are the hottest topic currently being discussed outside of, say, the likes of AI. And I think as long as you are in the element which has the highest liquidity, I think there's a huge opportunity there. Removing what they potentially are and actually simply looking at the trends, I think to really become the true first crypto trend follower, I think there's a huge opportunity, and I would love to be part of that.
I agree with all of that, except I would just file that under marketing. Bitcoin's no more exciting than cocoa. Unless it's made more money in cocoa, I'm still going to put cocoa ahead of Bitcoin. I mean, it's just a trend. It's going to have good days and bad days. It goes up. It's no better than anything else. We've all stipulated on this call, I think, even that all these markets, you can't break a market. They're all the same. They're all good markets. They all trend. As long as it's not an index, they're all worth trading. They have their day in the sun. It's nothing mysterious. I think it's great that everybody acknowledges that probably something like trend following would be the best way to handle it, because nobody really understands it or knows why it's going up. And we size inversely to volatility. So you take that issue off. So what if it's volatile? It doesn't matter. We all have small positions. But yeah, adding Bitcoin, we trade Bitcoin, and we have since the futures began. It's great. Ethereum as well. And I'm just excited that more of these coins may come out under Trump. It looks like that they're going to promote this idea. So there's a couple more out there. maybe we'll build this fifth sector: currencies, commodities, stocks, bonds, and crypto coins. I'm excited, but only from a trend following centric point of view.
What do you mean by that, Jerry? Do you mean from the fundamental perspective, you don't think too highly, but from a trend following perspective, you're like, hey, bring it on?
I try to explain this to my wife. I'm like, don't be so down on it and don't be so negative. Once again, there's pros and cons. Let's end up probably somewhere in the middle, but liking to trade it. And I do think there is one thing about it that is worth remembering, which is that unlike fiat currency, which I hate that term because it's usually said by kooks, it's supposedly not going to be able to increase its supply. So you have to pay attention to it. Why? Because the world is paying attention to it. And it looks like there might be something there. And then that is one of the life lessons that I've learned in the same way about trend following. Do I do this trade? Yes, you always do the trade because the downside is a small loss. So I advise all my young friends, whenever you hear about something, I don't care what it is, something new, something crazy, something that probably, you're right, it's probably not going to work, but don't be a skeptic. Put it in your trend following portfolio or in your personal portfolio. It's one of many different ideas. You could hit a outlier trade here because the downside is you'll take a small loss or it'll be a small part of your portfolio. Get rid of skepticism. Get rid of digging too deep. You don't want to dig deep. It's a breakout. It's in the news. It looks strong. People are talking about it. Don't let your pride get in the way. I was like the biggest skeptic of the iPhone when it first came out. And how dumb was that? The odds are against you. You want to discount all this euphoria and people being silly, but underneath it, a lot of times you could get on the ground floor of a really nice long-term trend. As we all know, you don't have to be accurate even 50% of the time.
To bring Moritz in here, I've been watching for years and I do enjoy a lot of his writing, but Nassim Taleb has been like just ranting against Bitcoin forever. It's at 117,000. So building on Jerry's point, what's your perspective on all this, Moritz?
Yeah, he can allow himself to do that. I'm very open-minded about this. By the way, there's quite a few systematic trend-following crypto funds out there. They trade on crypto exchanges. We don't do that. They're very successful. When you look at their return streams, the risk-adjusted returns they produce, the alpha richness in the crypto space is just very large, and they exploit that. And all of these things work differently. The meme coins, they go to the moon, they fall to the floor. Bitcoin kind of like stands out with its limited supply of 21 million coins, a lot of which have already been lost. And look, the reality is the price is at 117,000 and it was greater than 120,000 yesterday. That is what the market says it is. I found it very interesting to observe that at the very beginning, Bitcoin did its own thing. Then Bitcoin became correlated with the NASDAQ, kind of like this risk on, risk off type of thing. Ethereum became correlated with tech stocks because it's kind of like a technology, by the way, it has not limited supply. And Bitcoin changed its correlation profile and it seems to be doing its own thing. I agree with Jerry. The worst thing that can happen is a small loss. It's an independent enough market. We trade Bitcoin futures and I think it's great for our portfolio. I'm no maximalist. If it goes to 3 million, great. If it goes to 200,000, great. If it goes to 50,000, that may be great too, because I might be short. Either way, it's going to do something, and I'm just looking to be there for the ride.
Gareth?
Yeah, pretty much bang on with Jerry there. I'm market generic all the way. Price trends are price trends. I quite like the peso. So long as the opportunities are there, pretty much generic about which markets we trade. It's more about the selection, the diversification than the individual markets. And like I say, I'm quite happy trading peso. I don't disagree. The opportunities are good in crypto and makes a lot of marketing sense. But yeah, again, price trends are price trends, whether it's Bitcoin or peso or even the Canadian dollar recently has woken up and decided to move around for us as well.
Jerry, there are a ton of books about trading psychology. Morgan Housel has a bestseller. There's been many over the years. Van Tharp talks about these things, Alexander Elder. But to be a trend-following trader, that's inherent. To have an understanding of the psychology that goes into it to be successful, it's inherent in trend following. Speak to the psychological component and perhaps even go back to your earliest days of understanding the mindset, the psychological component as it weighs down on you and how you balance it, how you deal with it. Or is it just simple. I follow the rules.
No, it's not that simple. I was really slow out of the gate. I was the worst performer because the bottom line was we were told just do the trades. And so after a week or two, I hadn't done many trades. And so I froze up. Before you put the trade on, I really don't want to take that loss. And so I froze. Rich was not tolerant of people not being able to follow the system and blaming it on distress or anything. You just have to do the trades. You have to follow them correctly. I'd like to maybe get into a little bit of the difference between my comments on some of the things that the Bowmoor guys are doing with this answer. But I would say that trend following, the way that Moritz and I practice it, it is very psychologically difficult. The drawdowns, the volatility, letting the profits run. This is all part of the reason that it works. It's hard. It's difficult. You should do the hard thing, do the right thing. Part of the reason that it works is you should suffer through these drawdowns and follow these systems. These loose pants are going to produce these drawdowns. Just go with it and it's fine. You're protecting capital. You're taking small losses, but you're really trying to follow this system that maximizes the profit. It doesn't scale back, doesn't do this managed futures, Bowmoor type of daily rebalancing, which is taken over. And in fact, one of the things that bothers me more than anything is when mostly unsophisticated people will start talking, or people who are not really traders, hopefully, about how you should devise a system that meets your psychological needs, which was the exact opposite of what we did. We hated our system. We hated the psychological characteristics. We loved the system and the drawdowns because it meant we were doing a system that was going to work and that had a positive expectation, and we were getting the good and the bad of it. But managed futures has evolved into cutting profits short, getting out of your cocoa when it's making all-time highs because the volatility is high. The style that we practice, which is this traditional classic, letting profits run, letting that cocoa position and the ATR start exploding, get really large, not paying attention so much to this daily volatility and normalizing each position every single day, but letting the profits go and run and having these outliers maximize our compounded annual growth rate the way that they will, at the same time producing these uncomfortable drawdowns. So I think if you need to have a system that suits your personality, one that you can follow, then don't trade. Because the trading that I know, the trend following that I know about, is not easy. It's very difficult. And it has nothing to do with pursuing ease, comfort, and pleasure. It comes from doing backtest, accepting and utilizing robust systems that are uncomfortable with drawdowns and volatility.
Jerry, to quick follow-up, looking back on your early career, your early learning, you must have just been thinking to yourself, hold on, I'm in my 20s. This guy Rich is in his 30s. How did he figure not only out the systems, but understanding the psychology at such a young age?
That's the deal. I mean, that's the missing part of the Turtle story. Honestly, 90% of the Turtle story is two genius people who taught us principles and philosophy. There was no such thing as the turtle markets. We were told to diversify and pursue as much diversification as possible. Correct, the turtle systems did stop working, the shorter term systems. In the late 90s, we abandoned shorter term breakouts because you just get too chopped up and can't stay in gear with the trend. And so things that do evolve, the markets do change over time. That's why we were not taught to rely upon those specifics and those specific parameters and specific systems, but to evolve and learn the basics that were going to last us a lifetime. But yeah, that's the whole thing, is that we were fortunate to work under these two guys who were super geniuses, one a math genius and a computer genius, and they were doing back testing. There's also false information out there about they were pit traders, which is just a total joke. Of course, Rich was a pit trader, but they were doing high-level math with Bill Eckhart and back testing on computers. This is the big part of the story. I'm just more shocked. I'm glad to hear what the guy said today, but I think that's one of the things that just shocks me more than anything. If I was starting out trading like a lot of these people are over the past 20, 30 years, I would just devour everything. I would call me up. Tell me what's not in the books, what's not on the internet. People don't pay that much attention, enough attention to all the secrets that Rich and Bill had, because they're not all out there and they're not really followed. People will say, Rich coined this idea that he could print his rules in the front page of the New York Times and nobody would follow them. I think when he said that, what that meant was they wouldn't have the discipline to follow that. That's the early days. Now, this new generation, they have the discipline, but they're smarter. And so they wouldn't follow the rules on the front page of the New York Times because they know better, not so fast.
Moritz, if you want to respond to anything Jerry said or add to it, or if you just want to jump into the question I had about the psychological part of trading.
Yeah, the psychological part of trading is tough. I include myself in that. I think the longer you do it, the more experience you have with that line of trading, the more you get used to it. But it never gets away. The pain never really goes away. Sometimes you look at a position and it's become large. In the case of Jerry and myself, that can be the case. Coco, for example, and you look at this market and it sits on these big open trade profits and you already say, oh my gracious, what happens if that thing turns around? What's the loss going to be and all that type of things? But at the same time, we need to step back and say we can't really forecast what the next price move is going to be in Coco or any other market. It could go way higher. That is the best compass we have. Now, a lot of traders have deviated from that and they have started to micro tinker with positions along the way. And I'm not saying that all dynamic position sizing from a risk management perspective is bad, but the permanent, at least in my point of view, the permanent response function to correlation and volatility, where that is like an overlay to the core of the trading system in and by itself, that to me never clicked. It tricks us into doing mean reversion trades. When I separate these volatility-driven trades from the core system trades, which are based on breakouts or other methods, as Gareth was saying, I'm a big fan of system diversification as well. But when I put them in a separate bucket and just the sum total of the P&L, net of everything, bid offer spreads, commissions paid, market impact slippage, go down the list, it's not a beautiful picture. And it distorts the very important statistics of our trend following trading process that allows us to view a trade in terms of ATRs or in terms of risk and all these type of things. As soon as you change a position, once you have it on, your original risk is no longer defined in ATR or R terms. Some people even increase positions. The volatility becomes less. They increase positions even though they're in a losing trade. What that means when you think about it is you're adding to a losing position. If that position continues to go against you, you're going to be losing more than the 1R that you originally budgeted. It's these type of things that I'd like to stay away from. We have a view on risk, but we don't want our returns and our system to be impacted by noisy volatility and noisy correlation. And volatility is incredibly noisy. Volatility itself is massively volatile. It's mean reverting. Correlations are massively noisy. They're really unstable. Things that have been correlated with whatever X over the past 2 weeks, they might be correlating with something that's completely different when you have the trade on. So I ask myself, what is my edge operating in that space? Do I have an edge responding to these fall in correlation patterns? And when I step back and I'm honest about it, the answer is no.
And I would just say I'd have to add that to my list that I came up with earlier. It's got to trade stocks, got to get away from crisis alpha, got to get back to classic, got to get back to letting profits run, not cutting profits short, daily rebalancing due to correlation and volatility, and obviously not trading single stocks are probably the two major reasons that CTAs go through periods of poor performance.
I want to add something to that real quick if I can, and I think we touched on this, but I guess this is not about Bowmoor. Some of the largest trend following funds in the world, they have adapted that approach for reasons that we can understand, like from a business development perspective, where all of a sudden an institutional allocator shows up with $100 million ticket telling you that they don't want to really allocate $100 million, they want to allocate $500 million. And it's kind of like you're talking about these type of dynamics, really big allocations decided by people that have a paycheck, that work for somebody else, that have different drivers propelling that decision. And obviously, if you are the trading fund, you happily respond to that by saying, you know what, we're going to be lowering our volatility. We're going to be doing anything and everything that smooths the return profile and responds to volatility in the market. Because as soon as you do that, you're building up scale. You can trade fewer contracts, you can like smoothing things in and out, which allows you to absorb the 500 million ticket and then the next one and then the next one. That changes the business dynamics of the fund to the benefit of the fund financially from a cash flow perspective and to the disadvantage of the investor. And the investors rarely understand this. I mean, nobody's stupid. They should be pushing back on this, but they don't. Everybody feels kind of like happy in this space of 8 to 12% volatility with controlled return streams, small drawdowns, hopefully, and please don't give me a loss.
A loss is being up 30%. Now you're only up 25%. That's the new definition of loss.
Yeah,
not taking a small loss. Yeah.
Which is completely stupid.
Yeah.
But the downside is we're not going to be making you anywhere near the money that, for instance, Bowmoor is generating, or the Turtle systems have been generating, or some of the funds that we all respect still out there trading at a higher level of volatility are capable of generating. They're also capable of generating the drawdown and the loss, and it's happening right now. But they're still standing, and I would not be surprised to see them come up and make new highs and make more money on a percentage basis for their investors than any of these larger funds do.
Gareth, to summarize where they were going, essentially contrasting absolute returns against collecting assets, why don't you offer some perspective about absolute returns from your view?
That's what we're all about. That's an absolute cornerstone of my system. That's what we're looking for, absolute return. It's all about trend capture. I'm going to defend why we adjust position sizes. Perhaps just briefly touch on the psychology that you asked about as well. And psychology for me is more concerned with following the system and operating the system. It's less about what the markets are doing. By the time I started trading my system, I had gone through years and felt like I fully understood the system. I know all the rules. I've got a manual with them all clearly defined in there. It's all mathematics. It is also then a learning experience when you trade those rules and you follow those rules. It's probably that sort of experience with trend following where it's 2 steps forward, 1 step back. There's a frustration with that. I think human nature, there's a frustration with any type of process where you're taking, it's probably even 3 steps forward and 2 steps back. But I've long come to terms with it. My psychology is more concerned with how I'm following the system. I want to know that I'm operating the system well, and that's what I get more concerned about. I'm going to move on to the defense here of adjusting position sizes, which for me is completely paramount within the system. This goes back to something that I just absolutely absorbed in the early days with the Turtle system and the meaning of N. This is very important. To properly diversify requires making similar, ideally identical bets on many different markets to maximize the likelihood that winners will offset losers. This requires adjustment to harmonize market noise, precise portfolio allocation. This prevents one market from making all your noise. And that's part of this market generic strategy, is to reduce your positions to as close as you can have identical bets. Now, we never let that risk run away from us. You know, if we are increasing positions because the ATRs are reducing, we're also pulling our stops in because they're ATR based too. It's an ATR based framework. So we wouldn't let within that process of harmonizing the markets and our position units, we wouldn't compromise our risk control. That's a one-way street. We'll only reduce risk. We won't take extra risk simply because our unit size is increasing. The ATR-based stop would be reducing to maintain that very strict risk management framework. So for me, it's absolutely essential. We daily rebalance. It's a key component of how we preserve our theoretical risk of ruin, and the way that we prevent the micro tinkering that you'll often hear, that I think it was Ed to put it in those words. We daily rebalance, but we don't micro tinker with our positions. We use thresholds around our unit sizes. So that prevents just this, the effect of noise and any micro tinkering of the position sizes. We'll only adjust a unit if there has been what we would determine a significant change in the position size of that unit. That's determined by way of a threshold, and the threshold is functionally set within the smart pyramid. There's no optimization there. It's just a certain measure, which is based on the overall size of the position and how we build the position in units. So the thresholding effect just limits the amount that you may then just be tinkering with a position size. So although we rebalance daily, we trade based on directional signals and threshold adjustments to prevent overtrading and micro tinkering.
Let me throw it to Richard on a slightly different take with the trading psychology. Speak to your dealing with clients on the psychological side, like managing their psychology.
That is a significant portion of my role, and my distribution team's role is exactly that. It's managing investors' expectations. We have a breadth of investors, from the institutional investors who intricately understand trend following in the longer term horizon, down to the people who've potentially heard about it, who've now read a little bit into it, but don't intricately understand it. And it's more that level of investor who all of a sudden is seeing quite a heavy volatility. Now, again, one of the downsides with our strategy is we are visible on the likes of Bloomberg and other platforms. So one or two investors do or can track it on a daily basis. And with that, you see that noise, the noise Gareth refers to, you see the noise. So we will regularly have to deal with investors who are ultimately just seeing noise. It's not something we want them to look at or advertise that they can look at, but it is available. So yes, I spend a significant portion of my time re-educating or reaffirming the fact that this strategy is a longer term strategy, a 3 to 5 year horizon, but it does have an impact. We're seeing days this week where plus or minus 2% on a daily basis. That does, when an investor can see that on the likes of Bloomberg, it does have an impact and cause them to contact me to almost calm those nerves. We do a good job at it. Myself and I say the head of the distribution team know exactly how to word that, actually let the investors know and refocus their mind on the longer term horizon.
I've got one final question, and I'm going to save that for Jerry. I'm only going to let Jerry answer that question because he's the senior guy here. But before I get to that, is there anything that I did not bring up today that any of you wanted to address? Moritz?
No, I think that is a very good wrap. I'm looking forward to the final question.
I'd just say you've got us on tenterhooks now on this final question, but no, nothing from myself. Just an honor once again to speak with all of you here today. Thank you.
Likewise.
It's something that we got into last time with Jerry and Moritz, and Jerry's got this interesting career to where he's active right now, but he was active in the 1980s. So the question, Jerry, it's not terribly unique or creative, but what advice would you have given your younger self, even though your younger self was successful as you know what?
Yeah, that's a great question. That's a question I tackle when I'm shaving almost all the time. I'm looking at myself in the mirror. You could hardly be more dedicated to trend following, and don't ever lose faith in that. One of the reasons that I've had the success that I've had is because I really always believed what I was taught, and I thought it was really great. Now, it didn't stop me from doing other research and listening to other people and maybe adding some minor stuff. I asked Rich one time, we used to take a 2 ATR loss. And then when we did the research at Chesapeake, we decided that 2 ATR loss was too close. It wasn't optimal. And his response was, oh, I know, that's just my personality. So yeah, I didn't have a personality. I didn't want to have a personality. I wanted just to go with the numbers. But by and large, having faith in your mentor and really believing in that, but at the same time being somewhat open-minded to they're human as well, and you could learn from others. You can learn by doing your own research and analysis. I think those are the two big things, or at least for me. I was just in a unique situation where it wasn't like I met these people for dinner. I was with them. We were in the foxhole together, not just learning the system and reading or talking about it, but actually on a day-to-day basis, going through the ups and downs, and then having a mentor in a pretend environment where when you lose money, not a problem because you were doing the right things. You were doing the right trades. If you made money and you were not following the system, then you would get in trouble. This is not the way clients treat you. And then when you lose money, sometimes we'll give you more money because it's not your fault. The markets have just been bad. And then all of a sudden the trends just take off after they give you the extra capital. That's just a huge advantage. And it's easy for me to say these things when this is the experience I actually lived. But if I could just correct something that was said earlier about, I just have to comment on what he was saying earlier about the daily rebalancing and bringing in the turtles and stuff, because I think I'm an expert on how that stuff worked and making these identical bets. part of the turtle strategy was to make identical bets, was to size the trades based upon inversely to the ATR. But it was only to normalize the losses and for each loss to be identical in dollar terms and give each trade these 2 ATRs and this 1% loss of the capital. But it was never from a turtle and trend following Richard Dennis point of view to daily normalize the movement of these trades. No, it was, hey, we have a profit, all bets are off, we're going to handle these profits entirely different. We're going to give them loose pants, a lot of room. Maybe they can turn into these outlier trades that can make us all a lot of money. So this is the part that I reject. And I would accept it, though, if it worked better, if you made more money, more compound annual growth rate. But you can't have it both ways. Really? You think you can have it both ways? What are we going to get? Nothing from sitting there with these big positions that are terrifying, this big cocoa. We get nothing for it. We don't get more CAGR, and you get lower return, lower daily profits, lower volatility daily, and you get more money than we do? I don't think so. So it doesn't make any sense. I would do it in a heartbeat. I'm too competitive. I'm too nasty. I'll do anything. I'll steal from anyone and everyone. But no, the numbers, the math do not support it, and we're not going to do it. And it's not classic trend.
Listen, I can only speak of my own research, and I found that by adjusting the ATR, the stops, the position, then what that allowed me to do during the trade was manage the risk. And certainly from my own research, a lot of those early trends, often the ATR can expand before the move takes off. If you don't allow for that, if you don't then react to the expanding ATR, move the stops out, reduce the position size to maintain your risk, then sometimes you just get stopped out because the ATR has expanded and you haven't moved your stops out.
Yeah, I think you're getting into other areas deep in the weeds because, obviously we have our own secrets. And so we don't, which we're not going to disclose, but to where we don't get in those situations. I will admit what I said, and it does look better from a Sharpe point of view. You can trick the Sharpe ratio by reducing this volatility, but we're all on record, I believe, as not in favor of using the Sharpe ratio. But yeah, if you use a risk-adjusted, especially Sharpe measurement, then reducing this volatility, even though you're making less money per trade and your CAGR is not as high, you will be able to twist the trend following into a situation where if you abandon letting profits run, you will come up with a better risk-adjusted return. But I reject that, and I reject Sharpe, as I think we all do. I've listened to all your podcasts, and so even though Managed Futures does not necessarily reject Sharpe and does care a lot about volatility, and the way they go about that is almost identical to your daily rebalancing, although you do say you don't care about Sharpe. But there's more to it. You bring up these ideas that create risk and uncomfortableness as it relates to letting profits truly run. Obviously, we have countermeasures to that prevent us from having undue high risk of ruin, which we can't get into.
Let's do this. I want one little follow-up question to Jerry, and hopefully everyone had fun. So this is not our only time. My first time looking at a screen with 5 faces, including mine. But Jerry, here's the quick follow-up question, and we'll end it here. You've been very loyal on my podcast and everywhere that I've seen you. You've done it again today, giving tremendous credit to 2 men that mentored you early. But you've also seen a lot in the industry, everybody, or of everybody. Are there any other mentors or influences in the trend following world that affected you? Or was it just, hey, I got in early with 2 guys that were brilliant and that was enough for me?
One of the things that would happen when we would go to these meetings with them, because we were not in the same office, they would not allow us to be in the same building, actually, So we would go to meetings in a different location, or they would come over to our office. We thought we were smart, but you would just leave these meetings just like shaking your head. Like, these are people from a different planet. This is way, way different. I look around Managed Futures and I see PhDs and maths and scientists and all these things people call themselves. I'm not hearing too many people that sound like Rich and Bill. But I will say it's close. There is one person that's very close, and that's Richard Brennan. So he's my second Rich. And he is the best, the genius, at digging deep into trend following, because the simplest trend following looks and seems on the surface, it can be very deep. And he is the best at doing the numbers, understanding the math, and then describing what is happening in a way that I'd never heard before. So I'd give him a number one, but then it's just 99.9% of CTAs adopt the managed futures CTA strategies of vol control and correlation control, except Rich and Moritz and me, and maybe Mulvaney. So I get a lot of inspiration out of Mulvaney, and especially Moritz as well, because of close friendship and camaraderie and seeing things eye to eye. We don't always agree exactly, but we agree and understand on the basics and the fundamentals. But believe it or not, I'm just saying, send me something that's going to change my mind. Put something out there that's going to change my mind from a back test, from the math. We just have not ever seen it. You got to let those profits run.
Final point for me, ever seen anybody share what I've just described, separate all the vol control trades, put them in a bucket and create a VAMI curve. Just create a P&L curve. And let's have a look at that one. See if we like it.
I understand why people want to do it. I understand. It makes perfect sense. It's lonely being classic trend.
It works both ways for us, the vol adjustment. So, it works the other way as well. When the ATR reduces and markets become very benign, we increase our position sizes. And the effect of that is that we can generate similar profits from the smaller trends too. Some of our biggest profits come from fairly small trends where the market has evolved and taken some time to move from one price level to the next. So it works both ways. As much as the increasing ATR would trigger a position reduction, the decreasing ATR would trigger an increase of position so that we can make big profits on the small trends as well. It's not always hiding from big profit. It works both ways. Quite often we are taking more risk to profit. There's all different types of trends. Some of them are more of your evolving, slower trends. We want to adapt to those.
I'm going to put a pin on all of you guys right there, but I will add something to what Jerry said, though, because why not? When you write a book, it's a big deal. And Jerry's friend Rich, who has been on this podcast, has a new book coming out. Please check out Rich Brennan's book when it comes out. Speaking of Richard, why don't you tell where people can go today to check out your firm?
Bowmoor Capital, and it's BOWMOOR capital.com. And by all means, feel free to reach out to myself directly, which is richard.liddle@bowmoorcapital.com, and would love to discuss it further. And if you want a direct conversation with Gareth and myself, I'd be more than happy to accommodate.
Moritz, where can people find you? Again, we've said this last time. If they can't find you, they might have an imbalance mentally, but where can they go?
Takahē.capital, LinkedIn, type in my name, you'll find it.
And Jerry, again, if they can't find you, you probably don't want them, maybe. I don't know.
Mostly on Twitter, I would say. Our new website, ChesapeakeCapital.com, is in the works. We didn't get to talk about the differences. One group trades 500 markets, one group trades 21 markets. So we need to do another podcast. Lots more to talk about.
I threw it open. I said, are there any other topics? And I didn't get any bites. It's not easy managing 5 faces on the screen, including mine.
This would start to rival a Joe Rogan podcast of I don't know how many hours.
Well, guys, fun stuff. Again, I appreciate you all coming on. And I have to say, after doing a podcast for a very long time, it's quite fun to do something like this where I can see all the faces and balance it around. And I think everybody got a pretty similar, we gave Jerry a little extra time, appreciatively, but I think it was a good showing for our first show.
Yeah.
Okay, guys, I appreciate it.
Thank you all.
Thank you, guys. All right.
That was fun.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.